India's strikes were tactical, but their impact is strategic, and the ripple effects are now being felt far beyond the line of control. Tensions on the border are spilling over to the markets, and the impact is visible. Today, the Sensex fell over 412 points. This is a drop of 0.5%. The Sensex is an index of India's top 30 stocks. The Nifty also ended lower, down nearly 141 points. The Nifty tracks India's top 50 companies. Both these indices opened strong, but they lost steam as the day wore on. By afternoon, there was a fair bit of volatility. Banking, auto and FMCG stocks, that is fast-moving consumer goods, FMCG, all of these stocks came under pressure. Clearly, the investors were pulling back. The market turned defensive, and the reason was quite clear. The conflict with Pakistan was escalating. But here's an interesting trend, not surprising though, interesting nonetheless. While the broader indices fell, defense stocks soared. In fact, they have been rising in value since the Pahalgam attack. Indian defense firms have added over $5 billion in value. Stocks of Hindustan Aeronautics and Solar Industries have soared. Solar Industries is a missile manufacturer. Investors clearly feel that an escalation is on the cards. They're betting on ramped up procurement and long-term gains for the defense sector. Across the border, the story is quite different. Pakistan's stock market has collapsed. Today, trading had to be paused in Karachi. In Pakistan's benchmark KSE 30 index, it plunged by 7.2% in today's trade. The KSE 30, this is after a 6.5% fall yesterday. Clearly a casualty of Operation Sindoor. India's strike is bleeding Pakistani stocks. Another index, the KSE 100, also crashed today. It fell by over 7,300 points. This is a drop of almost 7%. Since the Pahalgam attack, the KSE 100 has fallen by 13%. And the KSE 30 is down by nearly 14%. Pakistani traders are waiting for tomorrow. That's when the IMF board is meeting. They will decide on Pakistan's bailout extension. Will they get more money? That decision comes tomorrow. So the markets are quite nervous. They're under immense pressure. Guess who's making the most of it? Pakistan's iron brother China. Chinese defense companies are rallying. Some of them surged by double digits. And who are these winners? Avic Chengdu is one of them. Avic makes China's JF-17 and J-10C jets. Yesterday, its stock soared by 17%. Today, it rose by close to 20%. So taken together, that's a 36% rise in 2 days. In a month, Avic has gained 53%. Pakistan operates both of these jets, the JF-17 and the J-10C. And China supplies nearly 82% of Pakistan's arms. So while India and Pakistan face off, Beijing's defense sector is booming. There is a simple logic guiding these trades. If there's a full-blown war, Pakistan would need more weapons. And it has just one supplier to turn to, which is China. So if Pakistan loses any equipment in conflict, Beijing will replenish it, possibly quickly enough to keep the fight going. And this has nothing to do with product quality or innovation. This is purely about geopolitics. Investors are chasing the momentum. It may not last. This is at best a speculative spike, a reaction to the current events, and not the fundamentals of these companies. So how long would it hold? That depends on how the border situation evolves. India and Pakistan stand on the brink of war. Investors are not waiting for escalation. They're already pricing it in. And defense stocks are where that bet is landing.